setting it up and everything.
Yeah. I'm gonna put your face right here.
Yeah, do what you got to do.
Okay, great.
Oh, dude, get out of the. You're in the Discord. Get out. Just close Discord for now.
Okay, but is it just?
All right, we're live, man.
Which screen do you see right now?
I can see the Predicting Alpha terminal, and we're live now.
Okay, great. What's going on, guys? Big rally in the markets today. Huge rally in the markets. We got the S&P 500 up a huge amount of points. S&P's up almost 4.5% today. We're getting a big rally there, and vol's coming in pretty hard right now. So realistically, we want to be selling some vol here. We got Easter coming up on April 10th. So we want to be selling some vol here. So it's going to be a short week for everybody here. We got Good Friday. So a couple things that we're looking at today. We're going to start it off with Zoom. So we saw Zoom Technologies here. It was trending, and it looks like they got banned in a few places because of the Asian. It's going through China apparently, and so they are banning it for security reasons. Funny enough, we are actually using Zoom right now.
Good platform.
So what's happening is we got implied volatility up. It's pretty expensive right now. Implied volatility is extremely expensive. We think it's going to be a little bit higher than realized volatility. This is our forecast over here. So implied volatility looks like a good sale. It looks like a really good sell, actually.
Break it down for people who may not be familiar with these metrics.
Yeah.
What implied volatility? Yeah, you want to break down what implied is?
You can break it down.
Sure. So implied volatility is basically the market's forecast of how much something is going to move in the future. So this is for the next year. And what we basically do is what we know is that implied volatility is directly correlated with the price of options. So when you look to buy an option, right? Let's say you think a stock is going to go up, you want to be looking at how much that option is costing you, because when you look at it, you can determine how much the stock is thinking something's going to move, right? For example, let's say you think that Apple's going to go up and the option costs you $20. You have to make $20 or more on that option to break even or be in profit, right? So what we're basically saying when we look at Zoom here is the market is implying a lot of volatility. And based on our forecast, we think there's going to actually be less volatility than what the market thinks. So what does this tell us? It tells us that the options being sold around Zoom right now are expensive. And there's a trade to be made where we sell volatility rather than buy them. So we would be in this situation looking at selling options, not buying them.
Exactly. And, but there's, we still have to go one step further and think, okay, well, New York banned them, SpaceX banned them, NASA banned them. Is this ban going to continue? Right? So sure, implied volatility is high, but it might be high for a reason. So if you think that Zoom.
You want to type in Zoom news and we can see if there's any recent stuff that's come out?
Yeah. I was just looking at an article actually. Just looking at an article. So, so I guess the CEO was addressing it. Yeah, there's so many articles that you can look through, but if you can spend the time to at least try to make a prediction on if you think that there will be any news from now until Friday.
What are retail saying?
Retail are all over the place, man.
Yeah.
Let's see. They're thinking, it's going to be delisted. Obviously, retail is extreme here.
Yeah. But are they extreme in one general direction or?
No. Mm-hmm. Yeah, they're both bullish and bearish. It's pulling the stock both ways, and that's why we're seeing this insane implied volatility for the front month.
Mm-hmm.
So, I was thinking
the out of the money calls are still pretty cheap.
Yeah, out of the money calls are pretty cheap. The puts are extremely expensive. But I think that's because if there is news that comes out, this thing gets crushed.
Hmm.
right? So like that was the thing. We were talking about it in the group earlier today. Like, do we sell vol here? Like, sure, vol's expensive, but do we sell vol? And we decided not to.
Yeah, we were like, you know what? There's too much of a good reason why vol is higher, or why
Exactly.
vol is high.
Like, I could see the the news tonight saying Europe is starting to ban Zoom.
You think so?
Yeah, I mean that is definitely in the cards, and so I don't think we're being compensated enough for that scenario.
Okay, makes
Yeah,
sense.
yeah, yeah. And I think we
If
got
someone wanted
earnings.
to make a play around this, right? What would there be any recommendation, or is this a stay away for now?
Yeah, so okay, so one thing I would not be doing. I know these are expensive, the puts. I would not be selling them. Because you really don't know how bad the news is going to be. If you are going to take a position here, sell at the money vol. So structure a butterfly here, sell at the money vol, and then buy the wings. That's how we were going to structure it in the group. But like I said, it's just too much risk here, too much risk at play.
No, makes sense.
We got some earnings today. Well, we're not going to trade it just because it's such a small company. Just because the price of it is only $6.38.
Do you want to show how we use the scanner to find it?
Yeah. Okay. So we just scan for earnings dates. So any earnings. So we actually look at 600 of the most liquid equities, and SCAC has their earnings tonight, or yeah, they have it tonight after close. But the price of the equity is only $3.24. So usually we like to sell options on stocks that are at least $25. Just because we have a little bit of a bigger account, and we don't if the stock's too small, we're going to end up paying a lot in commissions. So
Yeah, we need to trade in bigger size.
yeah. So it looks like
But for someone
SCAC.
trading one lots, it's not a big deal to take a look at this. It's still worth taking a look at.
Yeah. Now you guys could actually buy vol here. So actually, vol is the implied move that's actually not pricing anything in. So you could like the average move for SCAC, which is right here. You can see these blue lines here. This is SCAC. It has some pretty big moves, but right now the implied move, nothing is being priced in. So if the stock was a little more expensive, I'd be buying vol here, but it's too small for us. So if you guys have a really small account, only a few $1,000s, you could try to buy some options here, both the call and the put for SCAC. What do you think, Sean?
That actually looks like a really good opportunity for buying.
Yeah, and I think this is
a low cost bet.
Yeah.
That if the stock moves, you should be in the money.
Right, and you can see right here, right? So, the blue line is the implied vol, and the yellow line is if we take out just the earnings volatility, right? And you can see that basically there's no move priced in, right? If we look at a company like
crazy.
Apple, for example.
Why would you see something like that in such a volatile climate?
It's because it's so volatile. Because it's so volatile that the market volatility is outpacing the event volatility.
Makes sense.
Yeah. So you can see with Apple here, you see how the implied vol overstates the earnings. The non-implied, like just if we strip out the earnings volatility. So you can see that, okay, basically, there is some type of earnings volatility priced into implied vol. But with SCAC, we're not seeing that at all.
Yeah, and if you looked at SCAC, if you looked at the skew on it, it was pretty wild.
Was it really? I didn't even take a look. Yeah, so market saying there's going to be a big move up or down. Right, here's the at the money options, and market saying, hey, these should be more expensive. The wings should be more expensive. So a good trade actually would be buying the at the money options on SCAC for tomorrow.
Yeah, buying a straddle.
Buying a straddle. That would be our trade. That would be that would be a very good trade. Very good trade for tomorrow.
Cool. I'm gonna make a little story on Instagram after if anyone wants to. This is a good trade idea.
Yeah, and I would go a little further out too. I wouldn't be buying like the weekly. I'd maybe go one more expiration out.
Yeah, because you're not paying much more in implied.
Exactly.
You might as well.
Yeah. So I would say that would be our trade recommendation for today.
You want to see if you want to quickly take a look. So something we always want to do, right, is now we've seen the data, we see an opportunity, we see a market inefficiency, a good trading opportunity. Do you want to take a look on StockTwits? Look online, just see if there's anything there that can give us a little more insight.
Take a look.
Right, what's retail saying? Right, we always want to get an idea of who's on the other side of our trades, because if we can find out, right, like, so for example, Jordan, if you look up today, we have a 24% increase in message volume, but I don't know how much regular message volume this gets, but clearly there's more retail eyes than usual on this.
Yeah, it's still really small though. It's like only 1,000 people are watching this, right?
Okay, so it is small. Yeah.
Yeah. So it's relatively small. But yeah, honestly, there's actually not too much action happening here. The last post was at 1 a.m. Or this guy right here, 7 minutes ago.
Hey, Jordan.
Yeah, no one's looking at this thing. So that actually could be the reason why volatility is cheap.
Exactly, right. So that's a good trading opportunity right there. Something quickly, can you go over what volatility is and maybe explain it using your random walk drunk guy? Siddharth, who actually took one of our courses, is in our live.
Yeah.
And he's asking us to do a review of what vol is.
Yeah. So let's take a look at a stock. Let's take a look at the S&P 500. Okay, and we'll just look at the stock price for now. So this is the S&P 500, and you can see before this period. So if we just maybe let's zoom in right here. It's relatively stable, right? The stock market just keeps going up, nice and slow, and you can actually see that. Oops. You can actually see that volatility during that time period. Here, we'll overlay it. Volatility during that time period was relatively low. So this is volatility here. Okay, so volatility is just how much the stock is changing every single day. But you can see
the measure of the rate of change.
Right. If the stock moves up 10% versus stock moves up 5%, obviously the 10% is greater, so it's going to have higher volatility. Yeah. But you can see that once we got this crash, right, volatility increased. As you can see right here, volatility shot up to the moon. So that's what volatility is, right? It's how much an asset is changing. Okay, so you'll have, like, for example, bonds will be less volatile than equities, and Shopify or Zoom will be more volatile than Coca-Cola. So we can actually place bets on volatility. I hope that makes sense.
The reason why we focus so much on volatility is that what options are a financial instrument that let you take a bet on where a stock will end up in the future, right? And to understand how much a stock is going to move within the time frame of your contract, right? Let's say you buy a 30-day option. To understand how much something is going to move in that time frame, you need to look at how volatile it is. And that's actually the direct measure of, how these options are being priced. The premium you pay for the option tries to match how much volatility there's going to be in the market. So that's why we always focus on volatility. And when we're looking to find a trading opportunity, when we're looking to use the predicting alpha terminal to actually identify a potential trade, we're comparing the implied and our forecast of volatility. So what does the market think volatility is going to be? And what do we think volatility is going to be? Because something we often find is that the market has a lot of biases in it. And there's a lot of irrationality and inefficiency within the market. And by creating our own non-biased forecasts, we're able to say, okay, is there a trading opportunity here, right? So those are the two numbers we compare to give us our first look at where the opportunity is. And then from there, it's our job to apply intuition, do research, look online to see, can we understand why there's this difference? Is there a reason why this inefficiency exists? So if we're able to find the inefficiency, we're able to identify why the inefficiency is there. Now we have a trade on our hands and we can structure a trade to capture that spread in volatility.
Well said. Well said. So this is another name we're looking at as well, Wayfair. It looks like they gapped up on some huge news that they are going to be doubling their sales because everyone's staying inside for COVID and they're all ordering online, right? So people are buying options like crazy on this thing. Implied volatility is up quite a bit today. It's still below our forecast. So we might not be keen on selling vol, but it is, if implied volatility does start to increase past our forecast or our forecast starts to drop, we're going to be looking to sell quite a bit of vol on Wayfair. And you can see that if we go to Wayfair here, there's a lot of retail in this space right now. Message volume is up 70%.
6,500 watchers.
Yeah, 6,500 watchers. We got a lot of retail coming into the space. They're all bullish. They're all lots of bullish people, and they're all buying options here. So we are looking to we are going to be monitoring this, and once we see a good signal here, we're going to start selling vol.
What's the skew like for it? Can you scroll down? Okay.
But look, there's a little bit of a bid here on the Delta 5s. See, it's picking up a bit here.
That's the retail's hopping in.
That's the retail buying the lottery tickets up here.
Hey, I don't mind selling lottery tickets.
Exactly. I don't mind that either. But yeah, you can see like the relative action, like it's pretty high. So, people are really bidding this thing.
What relative action is?
Yeah, it's just basically how much volume does it have today versus how much it usually does. So let's say, for example, when we have the tweet messages up, 67%, but we want to know how much volume in the options market is up, and it's up quite a bit versus how much it usually trades. So that's what it's telling us. Is there another question coming in there, Sean?
No, we're all good. I just took a quick look.
Nice.
So, are we going to take a look at one more trade here? Did we have,
Delta
today? No, it was Delta.
No, Delta's airline. We can talk about it for the upcoming trade.
Yeah, let's take a look just a little bit out. We'll look at Delta. So Delta Airlines is implying 11.95% move. Okay, usually it's huge. This was actually a lot higher though. Like a couple days ago, this was 20%. So it looks like the market's starting to say, okay, you know what? Volatility is settling down a little bit. And it could be a good trade opportunity. But the thing is, if we look here, Delta Airlines has never moved more than, 4.5% on earnings. Like, sure, okay. 3 times move.
Yeah,
all
3
time
times.
Move. Crazy.
The thing is, okay, it's going to move. It should move a lot because of all this uncertainty in the market right now. But 3 times its highest move ever, that's quite a bit.
Yeah, that's serious. Right? And why would this maybe be overstated, Jordan?
It might be overstated just because people are so uncertain and they need to hedge, right? You got fund managers who can't be taking a chance here. And so they're going to be buying up these options to hedge their positions.
So where's the opportunity come in?
Like, let's take a look at the skew on Dow. Like, look at that. This thing, the Delta 5 puts are 197 and the at the monies are only 138. Skew is insane here, right? You can see it's pretty high relative to what it has been in the past, but it's definitely come in. It's definitely come in quite a bit. People are starting to ease off now.
No, 100%. And what I think is it's always interesting to look at when you have a stock like this is, uncertainty is really high because of everything that's been happening in the past. But what's important is now we see like a potential inefficiency here, and now we need to dig deeper, right? And this is where research and intuition becomes so important. Volatility should only be staying high if there's more uncertainty to come, or more bad to come over the top of what everyone already expects. If what everyone already expects is priced in, then this high volatility may be overstated, right? So we'd want to look at how much do we know about what's going on at Delta, right? Like, has the worst already come, right? Or is there more bad to come, right? Are they saying like, we have no idea what earnings are going to be? Or are they saying we know that earnings are going to be down about 30%, right? How much is set in stone versus how much is up in the air, right? And something we can look at to measure this is the analysts that are looking at Delta, right? If we see a lot of agreement amongst the analysts that they all think, okay, like they're going to miss earnings, they're going to be down about this much, and we see like a sort of agreement amongst all of them, then maybe this volatility won't be as high as what everyone's thinking. But if no one can agree on what's going to happen in the future, now it's like, okay, maybe there's still room for like a huge move to happen here.
Yeah, exactly. And, even if we want to price our expected value here, like let's say,
yeah, let's take a look.
Yeah, like let's say, maybe we'll go to our ZM trade. So the implied volatility is 103. So, we can quickly come over here. Let's say we wanted to sell let's say we wanted to do the April 9th, April 10th. So if we wanted to sell the straddle, for example, what's it trading at? 120.
Is it trading at 120?
Yeah, 119.75. So if we wanted to sell the 120 straddle, the market is implying, 103%, right? So that straddle is going to be priced at $10, but our forecast says it should only be priced at 0.90, right? So that's 9. So, we are able to capture $1, right? It's only priced at $9 right here. So our expected value on this trade is $9. It's $1, sorry, right? It's the 10 minus the 9, which is $1. So it could be a good trade here if you guys want to take that, sell Zoom, but make sure you guys that you understand the risk that you're taking in regards to if there is any news, you'll get screwed. However, if there is no news, you guys are going to make a fortune.
Perfect. Here, let me see if you got any questions here. Okay, you want to take a look at SPY and do a quick analysis of SPY.
Yeah.
Kuda's asking us. He's saying he needs to learn some of the basics, just get a preview of what's coming his way. He's looking at joining our private group in the next little while.
Nice.
So yeah, if you want to take a quick look at that, let's see.
Yeah.
Let's do a quick overview analysis of
the S&P. Okay, so S&P 500 the S&P 500 right now for the 30-day options the implied volatility is 41.96. Okay. And our 30-day forecast is this number right here. So we think that volatility is going to increase going forward. Okay. Like the market's very slow right now. We've just come off an extremely volatile period. And so let me show you what that looks like. So this green line you see right here is the implied volatility. And this purple line is what actually happened in the last 20 days. Okay. So you can see that in the last 20 days, realized volatility or the actual volatility has been really high, but the market's saying, okay, it's going to come down now. It's starting to come down. So we actually think that this is understating what is going to happen in the future. Okay. We think volatility is going to remain high in the future, right? We had insane unemployment numbers. We had, like the government's throwing in trillions and trillions of dollars. The market is very unstable right now. People are still at home. I heard worst case scenario is going to be 24 months for the COVID isolation, which is insane, but that's it. Obviously worst case scenario. So the market's so unstable right now. And it's funny to see that the market implied volatility is starting to come in a lot because it should still relatively be high. So what you can do just off by looking at these numbers is you can say, okay, maybe I'm going to buy an option. Maybe I'm going to buy some straddles here because we want to take a bet on volatility increasing in the future. Okay. Another thing you can look at is the skew, right? So what is the demand for puts versus the demand for calls? Okay. And as you can see, the demand for puts is a lot higher, right? And for that reason, you might be saying, okay, maybe if I'm bullish on the stock, I could buy some out of the money calls because they're cheap. But if I'm bearish on the stock, I don't really want to be just buying outright puts. Maybe I could structure a different trade. Maybe I could buy a butterfly or something, right? So it's all about looking at, trying to get as much information as you can before you place a trade using options. Because there's definitely, as you can see, a lot of dynamics happening when it comes to the options market.
Exactly. And hey, Jordan, do you mind scrolling up for a second?
Yeah.
So Kuda, just to be clear here, right? learning to use this entire tool, there's a lot of functionality within it, right? There's so many different ways that you can look at and analyze a stock using it to add more and more layers to your analysis. At the very basic level, though, we're looking at a comparison of implied and realized volatility, right? So we're basically saying, okay, options are used to take a bet on how much something's going to move in the future. And the way that the options are priced and created as an asset is based on the market estimate of that move in the future for the time frame of the contract, right? So that is what we call volatility. So what we're doing at a basic level is we're looking at the market and going, what volatility is the market implying for the time frame of our options that we're looking at? And then we're creating our own forecasts of it, right? And that's at the top here when you see IVOL and RVOL, that's what those are, right? So IVOL is the market forecast of volatility, and then RVOL is our forecast, and we're comparing those two numbers. If we see that implied volatility is lower than our forecast of realized volatility, typically we're going to want to be long volatility or buying options. And if we see that implied volatility is higher than realized volatility, that means that the market thinks it's going to move more than we think it's going to move. We want to be selling those because we'll be selling options in that situation, or short volatility because people are overpaying for those options given how much something's actually likely to move in the future. So for every asset we look at, whether it's SPY, Apple, some smaller company, any of the cruise lines, whatever we look at, that is the fundamental basis of our analysis is what is the market forecast? What is our forecast? We compare the two, and when we have a disagreement with the market, when there's a difference, we have the potential for a trade. From there, we have to go a few levels deeper. We do our own research outside of the tool to try and understand why there's this difference. And if we're able to understand the difference and identify it, now we can structure a trade around it. And there's a couple different trades you can do, which we go over more in our group to actually capture that difference.
Yeah. And if we look at the skew here as well, it looks like it was down pretty low earlier last month, and it's coming back up. So we can see that the demand now, I guess, as we're rallying, hedge fund managers are coming into the market and saying, okay, let me buy as many puts as I can to hedge my risk. Right? They're trying to, I guess, lock in their gains. So they're buying puts to hedge their equity exposure. If you think the market's still going up, you should actually be buying some of these out of the money calls. They're super, super cheap.
So Kuda's asking if we consider volume and sentimental data.
Volume and sentimental data. So we do look at option volume, because we try to look at what is the demand for puts versus calls. So we do that, but we do not look at sentiment. I would say that we do look at it for earnings trading, but not for like directional bets on S&P 500. Cool.
Yeah, most of the time we're not taking a directional play. There are ways to skew our position to make it directional, but oftentimes we're betting on the size of the move rather than what direction it's going to move.
Exactly.
And you'll often see this in the professional trading space where people will be taking these bets based on the size of moves rather than the direction of moves, because the predicting of direction can be a little more challenging. And in the end of the day, what we're trying to do is say, where do we have an edge? Where can we get better information than the person on the other side of our trade? And somewhere that we can really get that in the option space is based around volatility. So we have a lot of confidence in the analysis of volatility, and there's less confidence when you start adding direction to it. So we just focus on where we're extremely confident, and then we capture that as much as possible. And by doing that, we have the edge in every trade that we take, and that's how we come out in the profitable overall.
Yep. You know what though? I think I'm gonna buy some vol on S&P. Like, it's so cheap.
Yeah.
Yeah, it's so cheap. Maybe like a 40-day option or something.
Yeah.
Like,
take a little bit of a gamble.
Yeah, I mean, well, I'm not even gamble. It's so cheap. It's a great hedge for the portfolio. If anything bad happens.
What options are you looking at purchasing?
I'm probably buy the 30-day out at the money straddle.
Oh yeah.
Yeah.
Are you gonna buy straddle?
I'll buy a straddle. Yeah.
Are you going to put any directional skew on it or no?
No, I don't think so. I was actually thinking of buying out of the money butterfly here, like just
Mhm.
sell some of this upside. But just vol is so cheap on at the money, man. I think I'm just gonna pick some up.
Nice. So, okay, just to wrap up, this was a pretty good live. Let's take a look at SEAC. Was that the trade we were analyzing for everyone?
Yep.
So here's the trade that you can take right now. Looks like a good trade, and we're going to go over quickly one more time why we think it's a pretty good trade to take.
Yeah. So what's my interesting? Okay, so it's a good trade to take because volatility is being understated right now. Okay, our forecast is almost 100%, and the implied volatility right now is 80%. On top of that, we have earnings today, and the market is not implying any move for earnings. Basically, all of the volatility is market volatility. That is what the market's saying. So what we can do is we can buy a straddle on SEAC, hold it through earnings tonight, and realize some gains there. Now, of course, with any trade, it's not certain, but this is a great risk reward trade. Okay, our risk here is very, very small, and our reward is very good. So we only have to be right a few times, and I think this is we are right here more often than we're wrong. So I think it's a fantastic expected value trade.
Perfect.
Cool.
Okay, last question we're going to answer, and then we'll hop off. Kuda's asking, on what do we base our skew?
On what do we base our? Okay, so the skew is, let's go back to the S&P here. So there's a few ways to measure skew. Okay, so you can measure skew by taking the delta 25 puts minus the delta 25 calls. Okay, so that's what we have here. That's 14% difference in implied volatilities. Now, another way you can do it is you take the implied volatility 25 delta puts minus the implied volatility 25 delta calls divided by the implied volatility of the at the money. This is called normalized skew. Okay, because you would imagine the skew would be huge on something like RCL, right? If we look at RCL, for example, right, it's much higher than the S&P 500, but that's just because implied volatility is higher. So we have to normalize it by this number to get a better sense, right? So those are the two ways that you can measure skew. Cool.
And then you also have that you have that skew chart, right? Have you looked at that?
Yeah.
Perfect. Okay.
So you can see, obviously, we're at extreme levels here, right? So, right, and that's because people are thinking RCL could go bankrupt. So there's a good reason for why these puts are up there. So a good trade, for example, would be like you going into the market, doing some extreme, doing a lot of good research, and then saying, okay, what are the chances that RCL actually does go bankrupt? And if you have a higher, if you think that you have more information than the market, you could sell these out of the money puts for a lot of money, right? So this is where you're able to use the data to see, okay, what is the market saying? And then now that you know what the market's saying, all you have to do is try to prove them wrong, right? And once you can do that, now you have a trade.
All right.
Cool. Awesome.
Okay, guys, we're going to wrap it up there. If you don't mind dropping a like on this live, that'd be really useful. We want to grow this page. We want to do these lives every single day between 10:30 and 11 a.m. and then do one at the close from 3:30 to 4 p.m.
Yeah.
So if you guys like this, if you want to see more of these videos, help us grow our channel a bit. If you don't mind sharing it or liking this video, that'd be great. Let us know if you take that trade or if you found this useful. We could really use your feedback. We're going to keep this up. So we'll talk soon. And if you have any follow-up questions, shoot us a DM on Instagram or join our Discord. Kuda, I know a lot of the guys in here are actually already in the Discord. So shoot us a message there. We'll be happy to go over everything with you.
Awesome.
Okay. Here, how do I? All right, everyone. Jordan, you want to stop sharing your screen?